Welcome back to Intermediate Accounting. This video covers evaluation and accounting for bonds payable. In the last assigned video, we looked at the accounting for bonds that are issued at par. In other words, the stated rate interest rate on the bond is equal to the market interest rate that's being offered by similar bonds. Also, when bonds are issued at par, the amount that the company receives from investors or bondholders when the bond is issued is exactly the same as the amount of cash that's going to be repaid to those bondholders at maturity, or the bond issuance price equals the bond's face value, or in other words, maturity value. But bonds are not always issued at par. If the stated rate on the bond is less than the market rate, or less than that rate that's being offered by similar companies, similar bonds, then the bond will be issued at a discount. If the stated rate on the bond is greater than the market rate, then the bond will be issued at a premium. The discount or the premium will be amortized over the life of the bond, resulting in an adjustment to interest expense. This video walks us through the accounting treatment, therefore the journal entries, of accounting for bonds that are not issued at par, accounting for discount bonds and premium bonds. Let's start by looking just a little more closely at how the selling price of a bond is determined. Here are the factors here. Now, we saw in an optional video exactly how bond prices are set based on the bond stated rate and the market rate or effective rate. Here we see the more broad economic components: supply and demand of the buyers and sellers, relative risk, market conditions, and state of the economy. The bond is, as we saw in an optional video, is equal to the bond's price at issuance is equal to the present value of its expected future cash flows. Those cash flows consist of the interest. Remember, the interest is determined by the face value of the bond multiplied by the stated rate on that bond, and also the amount of principal or maturity value or face value on the bonds. Let's start writing some notes. There are two types of interest rates that we're going to see related to bonds. The stated rate, which is also known as the coupon rate or the nominal rate. Coupon rate is what the term was originally, because the bonds were actually pieces of paper that had coupons that the bondholder would tear off, go to a bank, and redeem for the interest payment. We can also say it's the stated rate is the amount that's actually stated on that bond certificate. So this is the rate that is written on the bond certificate. And importantly, this is the rate that determines the amount of cash interest paid. And it's stated as a percentage of the par value or face value of the bond. So a 5% bond is going to pay 5% of that face value, which is typically 1,000. Remember, face value means the same thing as par value. And of course, the bond issuer or the borrower is the one that sets this rate. The market rate, also known as the effective interest rate, also known as the yield on the bond, this is the rate that the competitor bonds are offering, the rate out in the market, or the rate that provides an acceptable return commensurate with the issuer's risk. So if I wasn't going to buy one certain company's bonds, and I was looking for about that level of risk, what is the amount of interest I'd expect to get? And this is the rate that's actually earned by the bondholders. So we see one rate is going to give us the amount of cash interest, but that's not necessarily the amount of interest that's earned by, or necessarily the expense incurred by the bond issuer or earned by the bondholder. Let's move on to our next slide. So how do you calculate the amount of interest that is actually paid to the bondholder each period? As we said before, the cash interest or the interest payment is equal to the face value of the bond or the par value or the maturity value of the bond multiplied by the stated rate. And how do you calculate the amount of interest that is actually recorded as interest expense by the issuer of the bond? To do this, we multiply the interest expense is equal to not the face value, but the carrying value of the bond. And this is technically the beginning of period carrying value of the bond multiplied by not the stated rate, but the market rate or the effective rate. In an optional video, we took a look at this series of cash flow here. This one example of a bond, 100,000 principal, pays interest annually each year for 5 years, 5-year maturity. The stated interest rate is 9%, resulting in a series of $9,000 cash flows by the bond issuer. And we said if the market rate is 11%, this bond is only paying 9%. Other similar bonds are paying 11%. We looked at how we can calculate this present value, the amount of cash that the company is going to receive when it issues the bonds at time zero. It's going to receive $92,608. And the reason for that is we're discounting each one of these $9,000 interest payments back to time zero at a market interest rate of 11%. And of course, we're also discounting the 100,000 principal that's going to be repaid at maturity back 5 years at 11%. That gives us the present value of the bond of $92,608. Now, we don't need to know how to calculate the present value of the bond. We'll always be given that amount. But the difference between the principal, the future value, the face value of the bond, 100,000, and the present value, the amount of cash that's going to be received at time zero, that difference represents the discount on the bonds. Here's some notes here. Discounts and premiums result from the buyer of the bond adjusting the interest rate from the stated rate to the market rate. In other words, at time zero, I'm interested, I'm the investor, I have excess cash, I'm interested in investing to get annual interest payments. I go out to the market, similar bonds are offering 11%. This bond is only offering 9%. In order to compensate me for the fact that other bonds would offer me greater periodic interest payments, 11,000 rather than 9,000, I'm going to pay less today for that bond. I'm only willing to pay 92,608 for the bond today. Then that makes me completely indifferent to whether I'm receiving 5 cash flows of 11,000 and of course my 100,000 at maturity, or not paying 92,000 today, getting 100,000 at maturity, and also receiving $9,000. Let's look at some examples. Okay, so assume that a bond has a stated rate of 8%. A $1,000 bond that paid, let's say, annually, you'd get $8,000 each period cash interest from this bond. Well, if the market interest rate was 6%, similar bonds were offering 6%, this bond is offering 8%. What does that mean for me as the investor? I'm really excited about getting this 8% bond. I'm going to end up paying more for this bond than its face value. So that bond would be sold at or issued at a premium. If the stated rate equals the market rate, the bond's going to be issued at par value or its face value amount. If the bond that I'm interested in a specific company is offering 8%, but similar bonds are offering 10%, the only way anybody is going to invest in this 8% bonds when it could get more from others is to now be able to get that bond at a discount. So a bond with a stated rate lower than the market rate is going to be issued at a discount. And once we take into account the discount or the premium, then investors are completely, the choice between this bond with a lower rate than the market or a higher rate than the market, you're completely indifferent. Whether you pay a premium to get more interest or whether you get a discount, because your stated rate is less than the market rate, you're completely indifferent. A bond discount, a discount on a bond represents additional interest expense. Right, let's take a look back to here. We see this $7,400 difference represents the discount, and the discount is due to the fact that I'm not going to pay $100,000. I'm the investor. I'm not going to pay $100,000 today to receive 9,000 plus, of course, my return of principal in the future. If I could go and get another bond of 11%, I'm going to pay less. I can get this bonds. I only have to give up 92,608 today in order to get these 9,000 payments plus my return of the full 100,000 principal. So the reason that the bond was issued at a discount is because the stated rate is less than the market rate. So that's going to be that discount represents additional interest expense. That additional interest expense will be recorded over the life of the bond. A premium works the opposite way. A premium represents a reduction in interest expense. So the issuing company, their stated rate on the bond is so high, so many investors want it, that they're actually able to bid up the price. They can receive more today than face value, than the amount that they're going to pay out at maturity, because those interest rates are the stated rate on the bond is so high. So the cash interest is going to be greater than the actual amount of interest expense for a premium bond. There are two ways that we can amortize the discount or the premium. We call this method of allocating the discount or premium to interest expense over the life of the bonds. We call that amortization. So this entire term here is the definition of the term amortization. Amortization is another way of saying an allocation. Two methods. One is the straight line method. Straight line method of amortization, where we look at that discount or premium. In our earlier example, it was about $7,400. And we say that amount of that discount or premium that we recorded when that bond was issued, let's simply evenly allocate that over the number of interest periods, or in other words, interest payments. So if it's a semi-annual bond, it would be 2 times the number of years to maturity. If it's an annual bond, it would be the number of years to maturity. And there's another method called the effective interest amortization method. And this method is a little bit more complicated. We take the amount of amortization is the difference between interest expense and the amount of interest paid. But what is the amount of interest expense? What is the amount of interest paid? Well, the amount of interest paid, that's pretty straightforward. The amount of interest paid is simply the face value of the bond or par value of the bond times the stated rate. But the interest expense amount is actually a little bit more complicated. The interest expense amount is going to change each period. It's going to be equal to the beginning carrying value of the bond we're going to multiply that. So the beginning carrying value of the bond will change each period as we're amortizing the discount or premium. And we're multiplying that beginning carrying value of the bond by not the stated rate, but the market rate or effective rate. And that difference between interest expense and interest paid is the amount of the effective interest amortization. Now, one more thing I want to mention about these two different methods. GAAP really prefers the effective interest amortization method, or what we call the effective interest method. It does allow the straight line amortization method, but with the caveat that the straight line method can only be used if the results, the calculation of the straight line amortization, are not materially or significantly different from the results if the effective method had been used. Let's take a look at an example. Buchanan Company issues 10-year 800,000 par value bonds January 1st, 2020 at 97. What this 97 refers to is bonds are typically issued at some percentage. When they're not issued at par, then they would be quoted at some. This 97 has an implicit percentage sign after it, meaning 97% of par value. So how much cash did the company receive when the bond was issued? 97% of par value of 800,000, which works out to be 776,000. That's the issue price. Now we don't know what the market rate is, but we do see that the stated rate is 10%, and we know that this was at a discount, so the market rate must be what? Greater than, less than, or equal to 10%. The market rate must be higher than 10% for these bonds to be issued below par value. The 10% is paid semi-annually on January 1st and July 1st. Let's record the company's issuance of these bonds. So of course the company receives cash. Just as we said, for the amount of cash is 97% of 800,000 or 776,000. What do we record as the amount of bonds payable? So now the company now owes. How much do they owe in the future? The company must pay out 800,000 in 10 years. So we record the bonds payable at their face value, the amount that needs to be repaid at maturity, 800,000, and that difference of 24,000 gets recorded as a discount. And discounts will always carry a debit balance. Let's look at the interest payments. What happens on the interest payments? Now, the entry is not just simply credit cash, debit interest expense on the first interest payment on July 1st. There's more to it than that. Remember, interest expense is adjusted by the amortization of the discount. On July 1st, 2020, the company makes its first semi-annual interest payment. So we know the amount of the cash payment. That's the easy one. So I'm going to jump to this credit here. I'm going to skip 2 lines, come to the credit. The amount of the cash payment, that's simply the face value of the bond times the stated rate of the bond, 10%. Now this is a semi-annual bond, so we can look at it as 5% being paid twice a year, or we can say 800,000 par value times the 10% annual stated interest rate times 6 out of the 12 months of the year. Either way, we're getting this results in 5% each interest payment. So $80,000 divided by 2 times 6 over 12. Every interest payment is going to be $40,000. The company pays out $40,000 in cash. We know we're going to record interest expense, but that interest expense is going to be adjusted by the amount of the discount amortization. So before we come up with the amount of interest expense as our debit, we stop here and we say, what is the amount of the discount amortization? Now the discount has a debit balance, and we're going to allocate this 24,000. We're going to start off by doing this straight line method. So we're going to evenly allocate this 24,000 across the 10 years. Since it's a semi-annual bond, we're going to evenly allocate this 24,000 across 20 semi-annual periods. So if we divide 24,000 by 20, we get 1,200. We're going to reduce the discount by 1,200. So the discount carries a debit balance of 24,000, and we want to reduce that debit balance. We need to credit the account discount on bonds payable. I'm going to abbreviate this here so I can fit everything, fit my credits all together. So the amount of the discount, we take the initial discount amount, which was 24,000, and we allocate it over the 20 interest periods. If this was an annual bond, we would do this once a year for 10 periods, but since it's a semi-annual bond, every time we make the cash interest payment or have an adjusting entry, we're going to amortize that discount. So this would be 1,200. And the amount of the interest expense is equal to the sum of the discount amortization plus cash payment. Or 41,200. So we see here, this is what we wrote down before. When a bond is issued at a discount, that discount represents additional interest expense to be recorded over the life of the bond. Let's do this one more time. December 31st, the company is putting its financial statements together. Remember, the next interest payment is going to take place the very next day, January 1st. So when we're putting our balance sheet and income statement together, we need to account for the fact that we've incurred interest expense, and tomorrow we're going to pay out cash. So as of the balance sheet date, we have interest payable. So again, we're going to have some amount of interest expense that's going to be equal to the sum of the amount of cash we're going to pay tomorrow. It's the balance sheet date, so we're recording this interest payable, always 40,000. Now January 1st, the next day, we debit this interest payable and credit cash. And we're also going to amortize that discount. Straight line, same amount every period. And the interest expense, same amount every period. What if the bonds had been issued at a premium? And again, on the interest date. Buchanan Company issues 800,000 of 10-year bonds on January 1st, 2020, this time at 103. So now we know how much cash did the company receive. This is implicitly 103%, 1.03 times 800,000, or 824,000. So it's the bond issuance price, or cash received, bond selling price. Interest rate is 10%, so we can infer based on this that the market rate must have been lower than 10%. Everyone wants this 10% return, or 10% cash interest payments to be received semi-annually for 10 years. They're bidding up the price, willing to pay more than face value, than the 800,000. So our journal entry, of course, the company receives cash of 824,000, as we just said. It's the 800,000 times 103. The company records the bonds payable at par value or face value. The amount it's going to repay at maturity, which is 800,000. And that difference, clearly it must be a credit, goes to the account premium on bonds payable. And premiums will always carry a balance that's a credit. Again, this 24,000 is going to be allocated across the bond's life or amortized and towards interest expense. And in the case of a premium, this amortization is going to decrease the amount of interest expense. Let's look at those journal entries here. Buchanan records the first semi-annual interest payment and the bond premium on July 1st, 2020 as follows. So again, start with what we know, the cash payment, that's the easy part, 40,000. Same as we saw before, because this is a 10% bond on 800,000 face value, semi-annually, so 6 out of 12. Interest expense is some amount. We determine what interest expense is by adding together the cash interest payment plus the premium amortization. Now remember, premiums carry a credit balance. So to amortize or reduce the premium, we need to book a debit to the account premium on bonds payable. And the amount is going to be, we have a premium balance of 24,000. Let's allocate that across the 20 periods, 20 semi-annual periods. 1,200. And so we need some debit plus 1,200 equals 40,000. Interest expense 38,800. See this as the cash paid. And we know that the premium amortization reduces our interest expense. The next interest payment is going to be on January 1st, 2021. But before we make that payment, the day before we're issuing our financial statements, we need to record an interest payable for 40,000. We're going to make this payment the next day. We have interest expense. We're about to put out our income statement. We need to show this cost of the borrowed money, cost of the bond. This interest expense, of course, is going to be this sum, or actually in this case, it's the difference. Again, we need to amortize the premium. Again, it's 1,200 because this is straight line, so it's always the 24,000 over the 20 periods. So again, our interest expense is 38,800.